Welcome back to the Japan FinTech Observer. Get ready for a quick hit of the latest news in Japanese finance and fintech. We're diving into the headlines, breaking down the trends, and leaving you with the insights you need to stay ahead of the curve. Let's go.
If you've been following the regulatory wires here in Tokyo, you know we've been waiting for this one. It is mid-December 2025, and the Financial Services Agency, the FSA, has just dropped a massive stack of documents on our desks. We are talking about the Cabinet Orders and Ordinances for the Reiwa 7 Amendment to the Payment Services Act. Now, I know Cabinet Orders sounds dry enough to put a caffeinated trader to sleep, but stay with me. Because what the FSA released on December 16th is essentially the operating manual for the next generation of digital finance in Japan. We're seeing a new rigorous framework for crypto intermediaries, a lifeline for fund transfer providers, and, crucially, a way for stablecoin issuers to actually make money. The government has opened a public comment period until January 19th, 2026. So, for the next few minutes, I'm going to walk you through these drafts, specifically the summary release and that incredibly dense new-old comparison table, to tell you what's changing and why it matters. Let's start with the big headline, the crackdown, or rather, the fencing in of the crypto intermediary sector. The amendments have formalized a new license category, the electronic payment instrument and crypto asset service intermediary business. These are the platforms sitting between you, the user, and the issuers or exchanges. If you look at the draft enforcement order, specifically the newly penned Article 1912, the FSA is drawing a line in the sand regarding asset safety. They are calling it assets that can be ordered to be held domestically. Here is the translation. If you are an intermediary operating in Japan, you must hold assets inside Japan that match the total value of your users' claims. The regulator is effectively ring-fencing Japanese user funds. If a global platform goes belly up overseas, the FSA wants to ensure that the assets belonging to Japanese customers are physically and legally stuck here, untouchable by foreign bankruptcy courts. And they aren't just looking at the money, they're looking at the people. The draft regulations introduce a strict look-back provision for executives. If you're a director or an executive and you are at a firm that had its license revoked, whether here in Japan or under equivalent laws abroad, you are grounded. You cannot hold a similar position in a Japanese intermediary for 5 years. This is designed to stop bad actors from simply jumping ship and starting a new company under a different name. The FSA is essentially saying, if you broke the rules in New York or London, you don't get a second chance in Tokyo. Now, let's pivot to the consumer side. If you've ever clicked agree on a crypto exchange terms of service without reading it, the FSA is trying to fix that. The new Article 19-10 is all about disclosure. The days of hidden fees are numbered. The draft ordinance requires intermediaries to explicitly list out every fee, commission, or remuneration the user has to pay. But more interestingly, they are mandating what I'll call volatility warnings. If a transaction involves a stablecoin or a crypto asset where the value could fluctuate based on a currency peg or another financial indicator, the intermediary must explain that mechanism. They have to explain why you might lose money. This aligns the crypto sector with the heavy-duty disclosures we see in traditional financial instruments. It's a move to treat crypto not as a niche gamble, but as a regulated financial product. Okay, let's move away from crypto for a moment and talk about the plumbing of money movement, the funds transfer services. For years, non-bank payment providers in Japan have complained about capital inefficiency. The rule generally was, if you hold 1 billion yen of customer money, you need to deposit 1 billion yen at the Legal Affairs Bureau. It ties up massive amounts of working capital. The Reiwa 7 amendments are offering a way out. The FSA is expanding the use of performance guarantee insurance and trust agreements. Basically, instead of locking up cash, companies can use bank guarantees or insurance policies. The draft text gets very technical here. I was reading through Article 17 in the comparison table, and it's full of formulas. But here is the takeaway. If a Type 1 funds transfer provider, those represent the big movers, can prove they have a solid system for early repayment and full preservation of funds, the regulator is cutting them some slack. They are introducing a 2-month buffer. Providers meeting these high standards can bear exchange transaction liabilities for up to 2 months. This operational window is huge. It reduces the cash flow friction that often chokes fintech startups. And to make this work, the FSA is widening the pool of who can act as a guarantor. Banks, insurance companies, and trust companies are now explicitly in the mix. It's a win-win. Banks get a new revenue stream selling these guarantees, and fintechs get to free up their balance sheets. Now, I want to touch on something that might sound minor, but is actually commercially explosive: stablecoins. In Japan, stablecoins are often structured as specific trust beneficiary rights. Until now, the rules on what you could do with the reserve money backing those coins were incredibly strict. Basically, it had to sit in cash or near cash equivalents. That made it very hard for issuers to turn a profit. The press release summary explicitly mentions a relaxation here. The FSA is moving to allow these backing assets to be invested in government bonds and certain bank deposits that allow for mid-term cancellation. Why does this matter? Yield. If you are a stablecoin issuer holding $100 million in reserves, and you can now earn, say, 1% or 2% on Japanese government bonds, your business model suddenly shifts from relying solely on transaction fees to earning interest on the float. This brings Japan in line with global stablecoin giants who have long operated on this interest income model. It makes the Japanese stablecoin market economically viable for the first time. Finally, let's look at who is invited to this party. The draft regulations clearly define the scope of business for banks and insurance companies entering the intermediary space. We are seeing provisions that allow traditional financial holding companies to set up subsidiaries for crypto and electronic payment intermediation. This is the convergence of TradFi, traditional finance, and Web3. By clarifying the rules on closely related persons and conflicts of interest, the FSA is rolling out the red carpet for the megabanks. They want institutions with robust compliance departments to run these intermediaries. So what happens next? As I mentioned, the clock is ticking. The public comment period closes on January 19th, 2026. After that, the government will review the feedback, likely tweak a few of the technical formulas regarding asset ratios, and then promulgate the final orders. If you're in the industry, whether you're a compliance officer at a crypto exchange, a treasury manager at a fintech, or a strategist at a major bank, you need to be reading the new old comparison table attached to this release. The devil is in the details, particularly regarding the calculation of liabilities and the definitions of eligible trust assets. Japan is sending a message with these Reiwa 7 reforms. They aren't banning crypto, but they aren't letting it run wild either. They are integrating it. They are demanding that if you want to play with digital assets in the world's third largest economy, you have to play by rules that look and feel a lot like banking. Thank you for tuning in to the Japan FinTech Observer. We'll be tracking the public comments as they come in, so stay tuned. Until next time.